Well, Robert, let's take a look at what happened at the market yesterday. Let's start with the fixed income market, the bonds market yesterday. An oversubscription of the bonds that was auctioned by the Debt Management Office. Did it come as a surprise, or was it expected?
Well, the event that happened at the fixed income market yesterday was really not expected. You would notice that for some time now, the equities market has been under intense pressure on issues bordering on the macroeconomic headwinds that the country is currently facing. While we noted the fact that most foreign investors have been staying on the sideline, particularly in both markets, what we experienced at the fixed income market yesterday was not really surprising, given that a lot of investors have seen the fixed income space as as a space they feel they can play in order to hedge against the market volatility. Of course, we saw that the February 2020 bond instrument was oversubscribed by about 120.8%. The same for 2034, which was oversubscribed by about 117%. It is still, communicating investors' belief that at the fixed income space, they still believe in the high yield environment. And let's not forget that most of the players at this space are the local fund managers, the PFA, who have classified most of their investment as hedge to maturity. So what we saw yesterday was not really surprising. It's in line with expectation.
So, like you already pointed out, it's just mostly the domestic players that we're seeing in the market, because foreign investors are still hedging, waiting to see if there will probably be another devaluation before the end of the year.
Exactly, because we are not, the foreign investors are not so sure of the next policy action of the CBN. A situation that would have been more reassuring for foreign investors would have been for them to be able to at least with some degree of confidence predict the next move by the CBN. Although the CBN has continually reassured the market that they are not about to devalue, but the factors that we can see around us are pointing towards the fact that there might still be a possible devaluation, and these are the reasons why foreign investors have continued to maintain their position.
And then we also saw that lending rates among the banks also was on a high side. It surged about 402 basis points to close at 23.79%. The banks have been the whipping boys in the last couple of days, especially with all the policies that are coming out from the CBN. How much longer do you expect to see interbank rates, be on the high side, at least for today's session and maybe tomorrow?
The issue at the interbank has been, the rates respond mostly to the level of liquidity in the system. And of course, what we saw yesterday was, consequent on the fact that liquidity in the system, is estimated at about 70 billion, according to the data from, the CBN. Before we would see a possible moderation at the interbank rate, we would expect some form of liquidity inflow, into the system. But in the near term, pending the time we begin to see some form of inflow in terms of liquidity, we would expect that the fixed income, the interbank rates will continue to be, on the high side. If we are going to make a projection, because there's no major inflow that is expected within that space in the near time. So we might just continue to, experience what, the market is currently experiencing. And you will note that the banks have been constrained by a lot of policies, regulations, coming from the CBN. So it's not also out of place to see the lending rates responding, as much as these banks are, willing to compete within the market for liquidity, for deposit, as well as, be competitive in terms of their rates. They also want to see ways in which they can, cover for the shortfall of the various tightening policies of the CBN. So it's also not surprising that we saw lending rates in the market, moving in this direction.
Well, thank you so much, Roberts, for joining me on the program and sharing your perspectives.
Thank you.